This video is part 2 of Introduction to Stocks. So once you've decided you want to buy stocks, exactly how do you go about doing that? Well, the first thing you need to do is decide which company you want to buy the stocks through, or which investment company or which brokerage company, also called a brokerage firm, do you want to open an account with. What a investment company or brokerage company does is these companies help people buy stocks. They act as a middleman between you who want to buy stocks and the sellers of stocks. For facilitating that buying and selling, they charge a fee. Some examples of brokerage firms or investment companies are Vanguard, Fidelity, Charles Schwab, E-Trade, and the sort of newest company is Robinhood. There are a lot more companies that help people buy stocks, a lot more brokerage companies, investment companies. These are just some of them. So once you've decided which company you want to buy your stocks through, the next step is to actually open an account with that company. For most companies, you can set up an account online without ever talking to anybody. But every single brokerage company, investment company has an option where you can actually call in, and there will be somebody there who will help you walk you through the step-by-step process to open up an account. Remember, this is basically their entire business, is to act as that middleman, helping buyers and sellers. So there will always be somebody there who can help you open an account over the phone if you'd like. So once you've opened up your account, you need to connect that account to your checking account at a bank or a credit union, and then move money from that checking account into your brokerage account. This whole process will probably end up taking somewhere between 2 to 4 weeks. Once you have an open account with money in it, you just go to the investment company's website or app, and on that there will be a way to buy stocks. When you're buying stocks, you will be charged fees. Number one fee is a commission. A commission is a flat fee for buying or selling stocks. For example, $4 to buy or sell up to 1,000 shares. For most people, it's a flat fee. If you buy a tremendous amount of shares, then it could be a little bit more. This particular commission, nowadays, a lot of companies actually do not charge this commission anymore. The second sort of fee you have to deal with when buying or selling stocks is the spread. The spread is basically the difference between the price to buy a stock and the price to sell a stock. The price to buy is called your bid price. The price to sell is called your ask price. And the price to buy a stock is always going to be a little bit higher than the price to sell. So if you were to buy a stock and then immediately sell it, you would still lose money off the difference between these two. And that difference is generally called the spread. So you have these two very general fees, the commission and the spread, and combined, this is the cost of buying and selling stocks. This cost has actually been going down for a very long time. As you can see, this is the average one-way transaction cost. So this is the cost to either buy or sell. And they have this as commission plus half of the spread. If you just double this, then this is the cost to buy and sell a stock. On your y-axis, you see this is the cost as a percent of that transaction. So if you are buying $100 worth of stocks and you are paying this 1% transaction cost, that means you're paying 1% of that $100 or $1. So as you can see, going from, to say, about the 1930s through the mid 1970s, the transaction cost was slowly increasing. But since then, transaction costs have quickly come down. The coming down has just been because of greater competition between these different firms trying to get people to use their company instead of the competitor's company. This is especially true with the invention of the internet. That has really brought down the cost a lot that companies charge. Now, I've talked about how to search for different companies. If you want to buy the stocks for an individual company, I want to now talk about some pitfalls that people who buy stocks in individual companies tend to fall into. Pitfalls is just something you have to look out for, something to be careful about. One, people who do this tend to often try to time the market. What does market timing mean? So we all like the idea of buying right before the market goes up and then selling the stock right before the market goes down. That's right there, market timing. You're trying to figure out when the market is going to go up so you can buy, and then figure out when the market is going to go down so you can sell right before that happens. So the problem with this is that you will probably fail at timing the ups and downs. No one can really consistently tell before it happens when the market's going to go up and when the market's going to go down. There are some people who are a little bit better than others, but there is nobody who can consistently figure this out. And this includes the professional people. So if even the professionals are really not able to consistently figure out when the market's about to go up or when the market's about to go down, then you and me, we're just not going to do it. It's not realistic for us to be able to time the market. And that's because the market, a lot of times, behaves in a way that is, for us regular people, doesn't seem to make sense. Let's take the year 2020, for example. Okay, so in the year 2020, in around the January-ish time frame, Australia was burning. We get into February. COVID has already been in Asia and has spread into Europe. So here in February, the market starts going down, which is what most of us would think would start happening. But if you remember back in the February 20th, it hadn't really taken hold in the US that strongly yet. So maybe you would have been able to predict that it was going to start wrecking the economy, but maybe you wouldn't have. So it goes down. Sure. Maybe you could have figured that out, but March 23rd was the bottom of that. And then the stock market just started going up. And I think very few people would have predicted this. March 23rd, it was still at the sort of the beginning of that first wave of Corona, where businesses were shutting down. There was cities sort of just shutting down their whole economy, shutting down schools, shutting down businesses, and the stock market started going up at this point. And then it kept on going up. And during the summer, when we had a second wave hit the southern US, and lots of people down in Florida, Texas, Alabama, Georgia, like there was widespread COVID happening in those areas, which were affecting that economy. Well, the stock market just kept on going up. And you see this tiny little dip here in that looks like maybe the beginning of September, maybe the end of October. But basically, during this third wave, where we're top 250,000 people dead in the US, topping 300,000 people dead in the US, people getting people getting sicker and sicker here in the US, still, the stock market continues to go in a general upward trend. So, I don't think many of us would have predicted that this is what would have happened, because this is not our experience with how the economy is. So, don't try to time the market, because what usually ends up happening is people will end up doing the opposite of this. There are lots of people who tried to time the market, and when they saw the market fall from February to March, they sold all their stocks, and then they missed out on this whole big rally. Or maybe they got all the way up to, the summer, and then they're like, oh, it's starting to get bad again. Let's sell all my stocks. And then they missed out on the gains from the summer through the end of 2020. So, pitfall number 1, don't try to time the market. You're probably not going to be able to do it. Pitfall number 2, even though this video has been talking about how to buy individual stocks, how to look at companies in these different sectors, look at companies that are either value or growth. In general, buying individual stocks for individual companies is actually not the best way to buy stocks. Stay tuned to future videos for us to talk about what is the best way to buy stocks.